ETFs are everywhere. They're simple, low cost, and promise easy diversification. But here's the catch. Most investors are making mistakes with ETFs that quietly eat away at their returns. From hidden fees to misleading diversification, these mistakes could be costing you thousands of dollars over time. Today, we're breaking down the 7 most common ETF investing mistakes, with real examples, and how you can avoid them. Stick around, because by the end of this video, you'll know exactly how to make your ETFs work for you, not against you. Welcome to ZAM Finance, where we explain investing concepts in a simple way. Before we dive in, a quick disclaimer. This is not financial advice. Now, let's talk about ETFs. Exchange-traded funds have become one of the most popular investment vehicles in the world. They're flexible, they're cheap, and they're easy to trade. But here's the thing. Just because ETFs are simple doesn't mean they're foolproof. In fact, many investors unknowingly make mistakes that quietly erode their returns over time. These mistakes aren't obvious at first, but they add up, slowly, silently, and painfully. So today, we're going to cover the 7 most common ETF investing mistakes, with real-world examples, and show you how to avoid them. Let's get started. Mistake number 1. Assuming all ETFs are diversified. Most people think ETFs are automatically diversified. And yes, compared to buying a single stock, they are. But not all ETFs are created equal. For example, let's compare 2 healthcare ETFs, XLV, the Healthcare Select Sector SPDR Fund, and VHT, the Vanguard Healthcare ETF. XLV holds about 65 companies, mostly large-cap giants like Johnson & Johnson and Pfizer. But here's the catch. The top 10 holdings make up over 50% of the fund. That's a lot of concentration in just a few companies. VHT, on the other hand, holds over 400 companies, including mid-cap and small-cap healthcare firms. Its top 10 holdings make up only 44% of the fund. So, while both are healthcare ETFs, their diversification levels are very different. If you're not checking the ETF's fact sheet, you might end up with a fund that's far more concentrated and risky than you realize. Mistake number 2. Thinking ETFs are risk-free. Here's a common misconception. ETFs are diversified, so they must be safe. But that's not entirely true. Even broad market ETFs, like those tracking the S&P 500, can lose significant value during a market crash. For example, during the 2008 financial crisis, the S&P 500 dropped by nearly 50%. And in smaller downturns, it's common to see 20 to 30% declines. The problem is that many investors assume ETFs are immune to market risk. This mindset can lead to panic selling during downturns, locking in losses that could have been avoided by staying invested. Remember, ETFs are safer than individual stocks because they spread your risk across multiple companies. But they're not risk-free. If you're not prepared for market volatility, you might be better off with safer assets like bonds or savings accounts. Mistake number 3. Ignoring fees and commissions. One of the biggest selling points of ETFs is their low cost. But even low-cost investments can quietly eat away at your returns if you're not paying attention. There are 2 main types of fees to watch out for. Expense ratios. This is the annual fee the ETF charges to manage your money. Passive ETFs, like those tracking the S&P 500, usually have very low fees, sometimes as low as 0.03%. But actively managed ETFs can charge over 1%, which adds up over time. Trading commissions. Depending on your brokerage, you might pay a fee every time you buy or sell an ETF. Here's an example. Let's say you invest $10,000 in an ETF with a 1% expense ratio. Over 20 years, that fee could cost you over $6,000 in lost returns. Always compare expense ratios and check for hidden fees before investing. Mistake number 4. Overlooking tracking error. Tracking error is one of the most overlooked aspects of ETF investing. It's the difference between the ETF's performance and the performance of the index it's supposed to track. For example, if an ETF is designed to follow the S&P 500 but underperforms by 0.5% every year, that's a tracking error. Over time, even small tracking errors can add up to significant losses. Tracking errors can happen for several reasons: management fees and fund costs, delays in rebalancing the ETF's holdings, liquidity issues with certain stocks in the index. To avoid this, look for ETFs with low tracking errors. A good ETF should closely match the performance of its benchmark index. Mistake number 5. Chasing past performance. One of the most common mistakes investors make is choosing ETFs based on past performance. It's easy to look at a chart showing a 30% return last year and think, this ETF is a winner. I need to buy it now. But here's the truth. Past performance does not guarantee future results. Markets change, and what worked last year might not work this year. Instead of chasing returns, focus on the ETF's strategy, holdings, and fees. Make sure it aligns with your long-term investment goals, not just last year's hot streak. Number 6. Trying to time the market. Many investors try to time the market with ETFs, buying low and selling high. But here's the problem. Timing the market almost never works, even for professionals. Historical data shows that missing just the 10 best days in the market over a 20-year period can cut your total returns by more than half. That's why staying invested, even during volatility, is usually far more effective than trying to predict the perfect entry or exit points. Instead of timing the market, focus on having a clear, long-term strategy. Dollar-cost averaging, investing a fixed amount regularly, can help you stay consistent and avoid emotional decisions. Mistake number 7. Investing in leveraged ETFs without understanding the risks. Leveraged ETFs are designed to amplify the returns of an index, often by 2x or 3x. While this sounds tempting, it comes with significant risks. Here's the catch. Leveraged ETFs reset daily. This means their performance over time can deviate significantly from the index they're tracking, especially in volatile markets. For example, if the index goes up 10% and then down 10%, a regular ETF might break even. But a 2x leveraged ETF could lose money due to compounding effects. Leveraged ETFs are not designed for long-term investors. They're better suited for short-term traders who understand the risks. If you're a beginner, it's best to avoid them altogether. So, there you have it. 7 ETF investing mistakes that could quietly be costing you thousands. The good news? Every single one of these mistakes is avoidable with a little knowledge and preparation. If you found this video helpful, hit the like button and subscribe for more investing tips. Let me know in the comments, have you made any of these ETF mistakes before? Thanks for watching, and I'll see you in the next one.